Elon Musk just doesn't do anything in small ways, right? Everything is kind of epic, larger than life. And now this Twitter deal is taking on a whole life of its own and is probably heading to court. We're going to dig into all this, including whether he can walk away, what his argument is, and what the company's going to do in response, because I suspect that this is going to go on for a while here. Maybe he'll get a better price deal out of it. I don't know. Maybe this is a negotiating tactic. As far as a legal one, we're going to get into the challenges here. Hello, everyone. Welcome to the Trish Regan Show. I'm Trish. Great to have you here. A reminder, portions of today's program are brought to you by Legacy Precious Metals. There's never been a better time to invest in precious metals, silver, gold, than right now. So go to legacypminvestments.com for more. Again, legacypminvestments.com. They have a free investing guide you can download right there. So back to Elon, back to Twitter here. This is really quite something. I mean, he's been making a ton of noise on this for quite some time. A lot of people are frustrated because they're like, wait a second, he wanted it, and now he doesn't. I actually think it would be a good thing for society in general if he were to get it, but he doesn't want it anymore. He made that very clear in his letter from his lawyer on Friday. Mike Ringler, a lawyer over at Skadden Arps, great firm, sent a letter to the company saying that Twitter has not complied with its contractual obligations and has a real issue here with these accounts. He wrote that Twitter has failed or refused to provide information. Sometimes Twitter has ignored Mr. Musk's requests. Sometimes has rejected them for reasons that appear to be unjustified. And sometimes it has claimed to comply while giving Mr. Musk incomplete or unusable information. So the lawyer is alleging here that Twitter has breached the merger agreement because of material inaccurate representations. The problem is that may not be enough to actually tear up the agreement altogether. In fact, what you need is something that he did actually reference a little bit later on in the letter. You need a material adverse change, known as AMAC, material adverse change, or material adverse effect. And he suggested that the stock price having fallen so considerably may be a reason for a material adverse effect, but still it's going to be it's a tall hill to climb. It is. Now, I want to go through the reasons why he may have something there. And then we got to get to the reasons why the court may ultimately say, yeah, sorry, no way, buddy. You promised $44 billion and that's $54.20 a share and you're on the hook for it. Just a note on the stock price, the lawyer writes that Musk is apparently paying attention to it because he writes, and is considering whether the company's declining business prospects and financial outlook constitute a company material adverse effect, giving Mr. Musk a separate and distinct basis for terminating the merger agreement. So really, that's the only way you'd be able to terminate the merger agreement. I've read through it, and Musk doesn't have an out. Like, the company has an out, but Musk doesn't really have one. If for some reason he were to really, really flake, they could still say, you know what, you're going to pay the $44 billion. I mean, and that's, by the way, what they've promised to do, because they're taking him to court. They just hired Wachtell, another great firm, for all their litigation. And they said, hey, we'll see you in court, buddy. You owe us $44 billion. So this is a very messed up, sort of intriguing situation. Back to what Musk is going to allege, what I suspect he's going to allege. He's going to say this is a material adverse effect in terms of the stock price. I don't think that gets him anywhere. I really don't, because I think that, look, the Delaware court's going to say, so what? Like, stock prices go up and down every day. You thought it was worth this. That's your problem. But what he might try and allege is that the business itself has been badly damaged because the accounts, they're not real. But again, the court comes back and says, well, how has that affected earnings? So the only time in history that the Delaware court has ever said, okay, well, this deal doesn't have to go through because of a material adverse change was back in 2018, 2017. It was a company called Acorn Pharmaceuticals. And basically the thing just imploded like days after the merger agreement was signed. And I mean, you look at what happened with the EBITDA, it dropped first by 86%, then its EPS fell by 105%, then 113%. And there was a real concern about the authenticity of some of its filings, which interestingly, Skadden has a good article on. So these two aren't related, but I just think it's interesting that I'm going to quote for you from a Skadden Arps piece where they're writing about the Acorn situation and how that deal imploded. And they said it was in part because this pharmaceutical company, Acorn, was confronted with serious, pervasive data integrity issues, which included submitting falsified product data to the Food and Drug Administration. Again, reading from the Skadden Arps piece, they wrote, according to the court, Acorn subsequently misled the FDA in meetings it sought about data integrity issues. In addition, the court found that Acorn's business fell off a cliff 2 days after its stockholders approved the merger. The initial revenue miss was down 25%, and then of course the 105%, the 113% declines that I just mentioned to you. So the Delaware court said, okay, well, you know what? This isn't the business you thought it was going to be. They didn't represent things as they should have to the FDA, and the business imploded. So this may be the argument here for Elon Musk. He'll say, well, you didn't properly account for your bots and your spam, and your business is suffering because just check out the stock price. The only thing is, I don't think the business is suffering enough for the court to say, okay, this is down 25%, then 100 and some odd percent, 113%. He doesn't have that in his favor. So what's really going to happen here? You're going to have a big battle in the courts. I don't think it's going to be that long and that drawn out, because I think the courts will look at this and say, okay, we have to come out with a decision. And I suspect, and I like Elon Musk a lot, and I have a ton of respect for him, and I think what he has done on so many levels has been just enormous from both a societal standpoint and from a business standpoint. I mean, the guy single-handedly created the EV industry effectively, right, with Tesla. Not that he's going to get any credit from it, from Joe Biden and company. And everything that he's doing with SpaceX, again, is tremendous, both from a business point of view, but also from a social point of view. And then you look at what I think he was trying to do here with Twitter, and I still hope he gets the chance to do, because I think we need more diversity when it comes to the speech arena. But maybe he's just saying, not for $44 billion, thank you very much, as he gets more and more into this. I just don't think there's going to be an easy out. Now, you could say it's a negotiating tactic. It's happened before. I mean, you can think about Tiffany and LVMH. I think that's sort of the only time it's happened, though. Again, there's not a whole lot of examples for this stuff. It's kind of unprecedented. But in the case of Tiffany and LVMH, the luxury company, they were able to get a haircut there on the price. In other words, LVMH said, all right, the economy just cratered. This was back in 2020. So the deal's different, and they went to Tiffany and they said, hey, we got to get a better price. And they gave them some number, and Tiffany just kind of laughed in their face. But eventually they negotiated a better price on the deal. And that may ultimately be what Elon Musk is striving for here. But legally, can he do it? Again, I'd go back to the merger agreement itself, which I've read, and he doesn't have a lot of leeway here. Unless he's able to prove that this really is a material adverse change or material adverse effect. And I know a lot of people say, okay, well, if it doesn't have as many counts as we thought, maybe that's it. It will come back to the earnings. And if the earnings are still okay, I don't know how that gets him where he wants to go. So watch this stock very carefully. I think the risk arbitrators are going to have a field day. I think probably a lot of people are going to be in there, maybe even buying it, in hopes that it does eventually close. But it's going to be wild. And you know what? There's going to be a lot of lawyers that make a lot of money on all this litigation. That is for sure. Hey, it's America, and we've got courts, and we've got litigators, and someone's going to make some money. We'll see how this all shakes out. Anyway, I want to talk a little bit about markets and innovative ways to think about investing right now. We've got a guest on the program coming up, Charlie Dombeck from KeyCity Capital, who's going to talk to you about how he makes money fixing up luxury cars that have been totally demolished. It's really interesting, and if nothing else, really quite something to see. Beautiful cars indeed. Anyway, before we get to that, I just want to give a brief shout out to another one of our sponsors, which is AMAC, the Association of Mature American Citizens, because I think the reality is we've all felt the crush of inflation, right? Inflation is really bad. If you watch what I did on Friday's podcast, season 3, number 118, you hear how I explain that inflation is so much worse than any of us even know or even thought. It's far more likely that we're looking at roughly 16% inflation when you consider what's going on from a historical standard. It turns out, like back in 1983, they changed the inflation metrics, they took out housing. And so consequently, the read you're seeing today of 8.6% is not fully authentic. We're going to get another read this week, but my only point is they're not being entirely honest, frankly, with us. The numbers are worse than they led on to be. And so consequently, you have a lot of Americans who are really struggling. A lot of Americans, we've seen in the data, they're living paycheck to paycheck. It's very, very hard. America's seniors are really feeling it. I mean, they're truly struggling to survive on very fixed incomes. And so this is why, it's time not to panic about it. It's time to actually act and do something. And this is why I encourage you to go check out AMAC, the Association of Mature American Citizens, amac.us/Regan, my last name, Regan, because this is a team of people who are working very actively in Washington, D.C. and all over the country to look out for America's seniors and to protect against policies that would lead to more inflation. I mean, there's tons of policies out there where they're like, okay, just print more money, just hand out more checks, right? That's the easy thing for politicians to do, but ultimately it makes it so much harder on everyday Americans, savers, and certainly America's seniors, which is why you should join AMAC. It's just $16 a year. You're going to get all kinds of discounts on travel, on restaurants, on hotels, all that good stuff, cell phone plans. And your money is going to go together with more than 2 million other Americans that care about the exact same things that I know you do if you're watching this show. And they care about inflation like you and I care about inflation, which is why this is a great group. amac.us/Regan. Go there right now. It's really easy. I've told you before how much AMAC cares about America, about you. And this is your chance to be part of that group. Together, I think that we all can make a very big difference. And clearly, it's very important right now. So again, just $16 a year. Forgive me if I said a month earlier. It is a year. This is a really good deal. So join or renew today at amac.us/Regan. All right, I want to get to some of the economic stuff. We've got inflation numbers coming out this week. That's going to be a big deal. I have a feeling they're going to continue to be bad. The only thing is they're actually worse than, they're worse than anyone's letting on, as I have explained. The other question is how do you plan for the future amid all that, right? How do you save? How do you invest? I'm so happy to have back on the program. I sat down a little earlier with him, none other than Charlie Dombeck from KeyCity Capital, to talk about both, one, where we are in this economic challenge, and two, how you invest. Watch.
We got a number of states across the nation that are really feeling the pinch. We got middle America, lower middle income Americans that are really suffering right now. And then we have jurisdictions like Texas, Florida, that are winning in the post-pandemic economy. So we've got a very unique environment, and we really do have strong tendencies towards a recessionary environment, even though we've got great job performance. We saw interest rates drop significantly this week. We're seeing just massive demand for rental real estate right now. There's a long waiting list in all of our units. Rental rates have skyrocketed, and people can't afford to buy single family homes. And you're seeing an increased demand for rentership, which is an early sign of a recessionary environment. And one of the things that the Federal Reserve has recently done is they've cut off the money supply. So the growth in the money supply is one major factor that drives how the economy performs. And we're at a 0% growth rate right now, coupled with massive increases in interest rates. And I think by the end of the year, if not already, we're in a recessionary environment. That's the fact that matter.
Yeah. Consumer spending is roughly 2/3 of overall GDP. So the consumer, a healthy middle class consumer, is super important to the overall integrity of the economy. And I'm really worried about the middle class consumer right now.
Absolutely, I am as well. And we don't feel it in some jurisdictions. I'm here in Texas, and by no means are we in a recession. We have Caterpillar moving here. We've got a $2 billion investment from a Taiwanese chip manufacturer. Florida is still booming. So these jurisdictions are still going to do very well, and maybe they don't experience a recession at all.
Right. And being in the South, I know that that benefits you guys in terms of the real estate businesses you have, certainly. But tell me about what you're doing today. What's this garage and these cars that are behind you there?
Yeah, so one of the things we noticed a couple of years ago is that our clients' fixed income portfolios were getting destroyed by ultra low negative interest rates, where clients could not get a coupon rate. And this especially hurt people who are on a fixed income. Think about it. Your fixed income rate of return dropped to 2 to 3% at best in the most recent couple of years. And so we have a lending strategy where we make collateralized loans in a couple of micro lending niches that allow us to charge ultra high interest rates for use of capital for short periods of time. And one of those spaces is in the ultra high end acquisition and renovation of lightly to moderately damaged cars. And I'm here in my shop today where we do some of our repairs. And I have one of the cars behind us that's being repaired. It's a 2021 Aston Martin Superleggera. And this is a car that was turned back into the large loss department at one of our major insurance carriers. And we're able to buy those things before they get to the auction. So this car had front end damage, taken to the Aston Martin dealership for a repair, and the repair estimate was $140,000. Well, I think it's going to cost us $12,000 to $15,000 to repair that car. I have a specialist mechanic that flew in from California that does carbon fiber repair. One of the only guys in the world that can do that, so he can do the work at a fraction of the cost.
What did they tell you it was going to cost to repair the car?
$140,000 at the dealership.
And what is it actually going to cost you?
It's going to cost me with Alan Lee from Alan Lee Designs about $15,000 to fix this car. But anyways, it's a car we paid $160,000 for. We'll spend about $15,000 in repair, and it'll sell for very, very nearly $300,000. And that is part of a lending fund that we have. And that lending fund generates a coupon rate to our clients between 9 and 12% per annum from day one.
Amazing.
So think about that.
Yeah.
You cannot find a coupon rate in the bond market. You can't find a coupon rate in municipal bonds, and certainly CDs and governmental obligations don't perform. So this is a great strategy to reallocate capital out of the financial markets in fixed income to a collateralized loan strategy. And this is just one of several micro lending niches that we have. I mean, this is a strategy that allows us to migrate capital out of an environment where we have a significant amount of risk, and we can immediately boost performance from an income perspective. And you don't have risk of whether or not interest rates are going to bring your bond prices down, or whether we're going to have just ultra low rates that don't generate enough fixed income for clients that depend upon that monthly income. So this is a great way to diversify and hedge and really to preserve capital.
Yeah, I see another car behind you there as I look at the screen.
That's a 68 Shelby GT350. It was an acquisition from a distressed owner that had to sell a car on short notice because of a financial issue. And we were able to buy that car at a very low discount, and that will be sold as well through our inventory, even though I'm enjoying driving it right now on occasion because it's just an amazing vehicle. We have now been sole sourced as the exclusive output for all of AIG's distressed ultra high-end vehicles. We used to have a regional presence with them on the West Coast, and now we have all of their business nationwide.
Again, my thanks to Charlie. It was a fun piece, certainly, to watch. You can learn more by going to keycitycapital.com/Trish. My name, keycitycapital.com/Trish. I encourage you to go check it out. Let me know what you think. And we're going to talk a little more economic stuff, a little more Elon Musk stuff, and a little more politics, again, on this program tomorrow. So do make sure that you subscribe if you haven't already, and that you like and you share the video. I'll see you tomorrow.